Hey, this is Justin with DayTradeTheMarkets.com on Tuesday, May 28th. I hope everyone had a nice extended weekend, Memorial Day weekend. And what I wanted to do today was kind of get to the basics. We oftentimes have people that will write in or call and say, you know, these charts look really interesting, or they may have just seen a few things. These charts look really interesting, but what does everything mean? And so what I thought I would do in today's video is just take the market today and break each piece of evidence down. And by piece of evidence, what I mean is that you can see here we have a chart with this has all of our different indications on it that are giving you different pieces of the puzzle, so to speak. In other words, we talk about there being, that your job as a trader is to be a good decision maker and to use good evidence and good education and good market knowledge to help you make better decisions in real time. If you can, rather than focusing on the money or focusing on your results, if you can instead focus on making good decisions, the money actually takes care of itself. And so the way that we look at this is we have different pieces of evidence, and the more of these pieces of evidence that come together, or the more that you can make sense of, the better your picture of the market's going to be, so that you can, number one, avoid being on the wrong side of the market, which is kind of overlooked, but really the most important first step. And then number two, once you've avoided being on the wrong side, hone in on a good way to get onto the right side of the market, so to speak, in a low risk, high reward opportunity type of a way. And then number three, manage your trades in an optimal way. In other words, try to maximize your profit on winning trades, minimize your loss on losing trades. And so the way that we look at that is we have various pieces of evidence that we use. We talk about our bigger picture bias and bigger picture key levels. I'll talk about that in a minute. Then we also have different pieces of real-time evidence that are really based on what's going on in the order flow of the markets. We have what we call relative aggression bars that form in real time and high velocity moves that form in real time. That's giving you kind of a roadmap as to which side is in control and to what degree they're in control of the market. Then we also have some other tools that can help you stay on the right side of things. Real-time support resistance zones, what we call deceleration and divergence, showing you when the market's slowing down and to expect a short-term turnaround. Then we also have a shorter-term directional filter, kind of the idea of the bigger picture bias, but on the shorter term, just looking at today's session, for example. So what I thought I would do is take this chart of today's action and strip it down to just price action, and then add each of these pieces one by one and talk about what they're telling you, what they told you today, for example, what they mean, and how it can help you, again, increase your edge by helping you become a better trading decision maker. So hopefully that makes sense, and you'll hang with me for a few minutes, and I'll show you what all these pieces mean. So let me first strip this chart down to basically nothing. Okay, so here is just a price chart, and obviously price is important, and price is how we keep score, so to speak, but price is really a symptom. We want to try to figure out and have some additional tools to give us an edge to try to get the reason behind price moves. And so the first way we do that is we try to put the market in context, bigger picture. So we're going to focus in on what we call our bigger picture bias and some bigger picture key levels or some bigger picture areas that we want to monitor throughout the day. So heading into each day, what we'll do is we have a report that we do for members, and heading into today, obviously, the bigger picture bias was up. So all things equal, we would rather be on the long side, and we know that if we're going to be on the short side, it's a little bit more aggressive. We're kind of swimming upstream, just to be aware of that so we can be a little bit more nimble, take on a little less risk on the entry side, be a little bit quicker to get out of a trade on the trade management side of things, but just kind of know where you stand, bigger picture context. Also heading into today, and obviously this has got the price for the day, but before the day, we recommend drawing horizontal lines where we talk about the areas of support and resistance. So heading into, the day after the weekend, we wanted to monitor, I guess Monday's high, and also we wanted to monitor this area around 68.75 and also another level around 81.75, and just kind of monitor what the market does at those areas. So that's a little bit of our bigger picture context. See how the market reacts at those levels, with the expectation that all things equal, we would rather be on the long side, but we're at least able to adjust if we see some real-time evidence that changes that, which I'll show you that came in this area. Okay, so the next thing we want to look at then is what we call our first building block, which are these relative aggression bars and high velocity move. So what just to give a little background on relative aggression, what these are doing, we have three levels of relative aggression bars. We have the moderate buying and selling aggression, strong buying and selling aggression, or what we call level 3 or extreme buying and selling aggression. And what these are telling us is they're analyzing under the surface the order flow of the market to tell us which side is actually more aggressive at a given time, because it's actually aggression that moves the market one way or the other. If neither side is more aggressive than the other, the market just sits there. But when one side, either buyers or sellers, is more aggressive, that's what gets the market to move. So these bars are giving you a quick and easy visual representation of what's going on. It's not just raw data. It's showing you, visually what is going on under the surface of the market, because it's this aggression, this order flow, that's actually going to move price. Okay, so it's telling you, number one, which side, buyers or sellers, is in control, and then to what degree. If you have an extreme level 3 bar, or even a strong, a level 2 bar, that's telling you, pay attention. This is not just noise. This is something major happening in the market. We want to see how the market reacts when one of these bars comes in, because it's going to give us a pretty good roadmap to the likely short-term direction of the market. Same thing with what we call high velocity moves. It's just kind of a redundancy, or another way to get to the same information that buyers or sellers are coming in pretty strongly. Okay, so what I'll do now is I'll pause this and put the relative aggression bars and high velocity moves on the chart. So we'll just look at that next. And so what you can see here is I've just got the price chart on the screen, as well as the relative aggression bars. And we've got these level 2 or strong buying bar, level 3 or extreme buying bar. Here's a level 2 selling bar. Here's a level 3 or extreme selling bar. We've also got these level 1 bars here, the light green and light pink. What I'm going to do, just to simplify it, the level 1 bars are good information. They're nice, especially if you're managing a trade or just kind of giving you a little bit of a heads up. But you really want to focus in on the level 2 and level 3 bars. So what I'll do is just take the level 1s off the screen. Okay, so that clears it up a little bit more. Again, the level 2 and level 3 bars are what we really want to focus on. And you can see that obviously we gapped up pretty big today in the market. And, the first major structure we had is what we call level 2 or strong buying aggression bar. And so, if you're thinking about a gap fill, you don't want to really fight that. You want to wait till some selling comes in, certainly. But our first question we ask when we have a buying bar comes in is, can the low hold? And you can see we did not have a full bar below, and then the high got taken out. So that's telling us, it's our first clue that at this moment in time, bulls are more in control. Now here we had a level 3 buying aggression bar, and it's right into that expected potential resistance, but our bias is still certainly up. So we want to see, again, can the low of this hold? Okay, it does. You can see we don't have any full bars above that or below there, and then we get some action above the level 3 bar. So again, showing us bulls are in control of this market, at least short term. Same thing here. The high of this level 2 bar gets taken out before the low is even tested. It's not until we come down here, this is our first sign that the pure bullish control may be weakening a bit, when the low of that level 2 bar is taken out. Again, it doesn't mean bears have taken over. It's just telling us this pure wave of buying is at least potentially coming to an end. Then you can see we test this, what was expected to be potential resistance now should be support. We test that, and we have a level 2. It's our first piece of selling structure, a level 2 selling aggression bar. So the same question, in this case, can the high of this selling bar hold? Okay. In this case it does, and then the low is taken out. That's telling us, again, this is at least a two-sided market. It's telling us that the pure wave of bullish activity has at least come to an end. We're now more two-sided. If we go make new lows, or we have some selling level 3 bars that come in, well, then we can say maybe sellers have taken over. But at this moment in time, pretending you can't see this half of the chart, at this moment in time, it's telling us that this market's at least two-sided. We want to be a little bit careful, okay? It's telling us there's not pure selling domination. So how can this help you? Obviously, at this point, you would want to avoid being on the short side, and you'd want to be looking for long trades, which we can talk about in a moment. And once this comes in, it's telling us, okay, better be a little bit more cautious, more of a consolidating market, thinking about fading the highs or the lows rather than going with on the long side. And then once you see this level 3 selling bar come in, and it's kind of a wave of level 3 selling bars, again, we ask ourselves, can the high of that bar hold? And you can see it does basically to the tick. And that, in fact, that's one of the trade types that I just love, is what we call the level 3 retracement trade, where you get a level 3 buying or selling bar, and you're basically buying or selling the high of that bar. It's really outstanding, resistance or support depending on the situation. So again, at this point, when this wave of level 3 has its high held, and then we take out the lows, make new lows, and even do so on, here's a high velocity move and a level 3 selling aggression bar on the low of the day. At this point, it's very clear that sellers have taken over control of this market short term. Now, with that said, bigger picture, we still have an up bias, so you know you'd have to be a little bit nimble. You don't just expect this thing's going to sell off forever. You want to be a little bit cautious, but at least it's telling you to avoid the long side. And hopefully you're getting the power behind that concept of number one. I like to say, number one is avoid being on the wrong side. So you can go into the day with an up bias, but once you see some selling starting to come in, it's telling us you better be pretty careful if you're going to be on the long side. You might want to avoid that. Now, whether you want to jump on the short side in this kind of a bigger picture up market is up to you, but assuming you're a little bit more aggressive, that certainly is a viable option. At least the evidence in real time is telling you sellers are starting to take over this market. Okay, so hopefully you understand what I'm saying. So then, again, level 3 bar and high velocity on the low of the day. If you're super aggressive, go on a breakout, but otherwise you're thinking that the high of this selling wave should hold. It basically does to the tick. Then we make new lows down here with a level 2 bar. So again, it's just telling us sellers are dominating this market. It's not until we test this support level at 54 and we can't get more follow through, and then we finally start to see some buying come back into the market. Again, it doesn't mean buyers have taken over and we're going to make new highs, but it's at least telling us short term this wave of selling which started here has at least come to an end. Now we're back to more of a two-sided market. Okay, so we head higher, and then shortly before the cash close, we start to get some selling come in, and we close basically on our lows. So that's a lot of our members simply just use these level 2 and level 3 selling bars, and frankly, you could just use these, and it could really help you again just stay on the right side of the market, avoid being on the wrong side of the market. You could just trade with those level 3 bars if you wanted. But if you want to go a little bit deeper and have a little bit more information, we can add some more pieces of evidence. So again, at this point, we've got our bigger picture bias. We've got our level 2 and level 3 bars. The next piece of information we want to look at is what we call our support resistance zones, and these form in real time. So when you see them on the chart here, that's when they actually formed, in real time. So I'll throw those on now. Okay, so at this point I've thrown on the support and resistance zones, and again these are these red and green zones that you see, and what this is telling us, this is a red resistance zone, this is a green support zone. Green support, red resistance, green support, and so forth. Okay, and so what these are telling you is that all things equal, and you have to be able to put this in context, you don't just want to blindly trade these support resistance zones. These are just telling us all things equal. If you are thinking about a long trade right into the resistance area, you might want to think twice. If you're thinking about a short trade and it happens to be at a resistance area, okay, that's giving you that extra bit of confidence. Okay, vice versa, if you're thinking about a long trade and it happens to be at a support zone, it's going to give you a little bit of extra confidence. If you're thinking about a short trade and it's into a support zone, it's going to say you better think twice. So again, it's not something you just blindly want to trade on, but it's another piece of the puzzle. It's giving you that another 1 or 2% edge. Okay, it's adding to your ability to make decisions. Okay, so that's support and resistance. The next thing we'll take a look at is what we call deceleration or divergence, and these again form in real time. And what those do, I'll put those. So now you can see I've got the deceleration and divergences on here, and what these are basically telling us is, for example, if we look at this bar right here, you can see that it has a higher high than the prior bar, but the level of buying aggression within this bar is actually slowing down or decelerating. So what's that mean? If you have a bar with a higher high but the level of buying aggression is increasing, then we would expect the market to move higher. However, if you have a bar with a higher high than its prior bar and the level of buying aggression is actually decelerating or slowing down, then all things equal, you would expect a bit of a turnaround. Okay, and these are very short term, and I can't stress enough that these are not trade entry signals. These are just giving you a little bit more information to very short term potential turning points in the market. So for example, when you see one of these, if you're thinking about a short trade and then it's at a resistance area and then you get a deceleration, a buying deceleration, it's giving you that, again, that extra 1% edge, showing you, okay, the market is slowing down here. You've got other evidence to work with. Here's another piece of evidence that's helping you make that decision. It's not telling you blindly take all of these like a system trader. That's not what it's doing. It's just giving you that extra 1 or 2% edge to confirm potentially a decision, showing you short-term areas where the market is slowing down. Okay, so hopefully that makes sense. The next thing we'll look at then is what we call our directional filter. So let me throw that on the chart now. Okay, now you can see that at the bottom of the screen there is a colored section here, and you can see that we've got, as it turns out, we've got all 5 colors. We've got gray or neutral, we've got green for strongly bullish, or dark green I should say, light green for bullish, light red for bearish, and dark red for strongly bearish. Okay, and what is this telling us? Is this something that you again trade blindly with? No, it's that extra piece of the puzzle. So it's telling us that all things equal, just looking at the shorter term structure and still having the ability to put that in context with the bigger picture structure, that the path of least resistance shorter term when the market's here is up, and then it's a little less up here, and then it's down, and then it's strongly down, and then it's more neutral at this point. Okay, and so again, what's that telling you? It's telling you that if the filter is dark red and you're thinking about a short trade, it's giving you, again, that extra 1 or 2% of additional confirmation or edge or confidence that that trade makes sense. If you're thinking about a short trade or a long trade and the filter is dark red, does it mean don't take it? Not necessarily. It doesn't mean blindly just don't take it. It's simply telling you, okay, you better think twice. You better reevaluate the evidence and make sure you really want to take this, because it's a bit of a red flag. Okay, so it's not the be-all end-all. It's not systematic. It's simply telling you, okay, the market in the short term path of least resistance in this case is down. You might want to be careful on the long side. You can add a little bit of confidence to being on the short side. So hopefully you're understanding this, and you can see the idea here that there's not some magic indicator, there's not some magic system, but if you can have a good way of making sense, or a better way of making sense of the market, so that, again, and I harp on this a lot, but I just think it's so important, you can increase your edge. And by increasing your edge, what we mean is, number one, avoid being on the wrong side. Number two, get onto the right side. Okay, so in other words, be going with the flow of the market and not fighting things, not put the odds in your favor, put time on your side. So if you can avoid being on the wrong side, and you can have a better chance of being on the right side, and then you can have a better chance of managing your winning trades for maximum benefit, and a better chance of managing your losing trades for as minimal loss as possible, that makes a huge difference over the course of a week, a month, a year in terms of increasing your edge. Is it magic? No, but it helps you become a better decision maker. So again, the point of this video is just to kind of show you each piece of the puzzle, each piece of evidence, hopefully make a little bit better sense of it if you're new to this, and you can see. If you have questions about that, or if there's anything you'd like me to clarify, by all means, just send us an email at info@daytradethemarkets.com, and we'll get back to you relatively quickly. All right, have a great evening, and we'll talk to you soon.